we appreciate you guys showing up today for this webinar on this. It's an incredible investment opportunity. We have a good handful of these investment opportunities out there. None of them that pay yearly quite like this right out the gate. We're pretty excited about it. This is the Cordell Capital Debt Validation Fund. It's us with Matthew Owens from OCG. His name underneath his face says Mafi Kalopa, but that's actually our virtual assistant that I guess he's under her account somehow right now. Anyways, yeah. So we'll go ahead and get started on it.
No problem at all.
All right, investment overview. What you guys are doing here is looking to invest in shares of Cordell Capital Debt Validation Fund, which then invests in promissory notes secured by pools of short-term accounts receivable contracts with a maturity of 24 months or less in order to receive a 20% annual rate paid out quarterly with a balloon payment of your initial capital at the end of 36 months. So the company's investment strategy focuses on lending capital to resolution processing. Matthew's going to go into a lot more detail about them here in just a minute. For up to 36 months, collateralizing on large pools of accounts receivable contracts to decrease risk. That on those we do UCC filings on those as well, and Matthew will go into that here in a minute as well. I'm kind of teeing it up for Matt to give you guys all the nitty gritty and get down into the details. Cash flows paid back quarterly at 20% APR. This investment carries no debt financing, 100% equity investment in order to decrease risk to investors. Pools of receivables will be collateralized from Resolution Processing LLC through accounts receivable loan agreements, whose primary purpose is to help consumers reduce their debt burden by 50% plus through a debt validation process. And I'm going to sound like a broken record, but Matthew's going to go over that with you here very shortly. All right, this is Matthew's team here. Matt, I'm going to let you go through your team. And if you just click on the up-down arrow, it'll also load those
awesome
captions.
No problem at all. Thank you so much, man. I really appreciate it. It's great to be here. I'm glad to be able to present this. It's an awesome opportunity. I'm super excited about it. I've done a ton of due diligence on this stuff and really dive deep into resolution processing, into the system, the accounts receivables, all that kind of stuff. So excited to do this. A little bit about my background. I'm a CPA. I live out in Southern California, got a degree in economics with an emphasis in accounting. We've now flipped a little bit over 1,000 houses now. We have over 35 million lent out to flippers in different markets around the country. I've raised a little bit over 150 million from private investors for these different investment strategies, investing both debt as well as equity investments in real estate, as well as other small businesses and things like that we invest in. So it's a lot more fun than doing accounting of a CPA firm, of course, and that monotonous work. So my partner on this deal, one of my partners on this is Catherine Bell. So I'm trying to click through the next thing. There it goes. Oh, there we go. So she actually is a very experienced investor, primarily focusing on mobile home parks as well as debt. So she loves doing those things, and her entire philosophy around investing is investing with a purpose. And that's one of the biggest things that we're doing here is we're actually helping a lot of first responders, vets, active duty military, police, firefighters, all be able to invalidate their debt through the debt resolution process, or debt invalidation process, which I'll talk about in a minute. But so this fits right in with her mold of what she really loves doing, is investing with a purpose, and that's what our focus is with this fund. So Rick is my Chief Operating Officer. He's actually been with me for over, I believe, 13 years now. So he's been working with us in the real estate arena, actually helping with all of our data and our AI and our migrations, as well as actually running our lending company, our affiliate programs, helping us with all of our assets. He's been awesome from every aspect of help for our clients. Justin is one of my close affiliate friends that we work with consistently. That we met at actually an event to help veterans create financial freedom through real estate, and he actually became one of my investment advisors and helps with a lot of my different strategies that we work on here at OCG. And then Deborah Smith is actually one of our partners with the Debt Validation Fund. She actually is also a CPA, worked on large real estate clients and things like that consistently throughout her career as well. So great at financial modeling, a great resource to have on the team. Let's see the next slide. We got Cam. You want to say what's up, Cam?
Yeah, what's up, everybody? Happy to be here. I'm running point on investor relations for Cordell Capital with Charlie. Started the last 3 months. Got to know Charlie and Matt very well, however, over the last number of years, which is why I'm super excited to be here, especially when Charlie told me that we were partnering with Matt on this deal, because I know his track record and everything he's been through. So yeah, I'm a Canadian. I still live up here, braving the cold, but perhaps one day I'll get down to the US with all of you guys.
All right, and you guys, most of you guys here know me. I'm Charlie Wessel, principal of Cordell Capital. Been married 23 years, 23 wonderful years. I have a 15-year-old son and 11-year-old daughters right now, and life is wonderful. They're all into sports. Living here at Charleston, we all love the beach, golf, fishing. It's a lot of fun. Anyways, we've been doing this, in this particular space of private equity since about 2016, 2017. Been here since 2006. Have sold several companies here. It's a great place. I love Charleston, love South Carolina. From Florence originally, but this is our home now here in Charleston. So yeah, I mean, we have just over 160 million in assets under management that we've brought investor capital to, and we were really focused in on multifamily until about 2 years ago. Just the inflation on costs and labor and construction and everything else has really made us focus on boring deals. We want boring deals now. Multifamily is not boring. It's very, very active, takes a lot of time. Anyways, last few deals we've done has been medical office buildings, that were fully occupied, not much to do, just collect rents and return investor distributions. So then we're looking at a law office right across the street from the county courthouse in Birmingham, Alabama. It's fully occupied, has a bunch of lawyers in it, and it's a opportunity zone deal. But anyways, today, this is what we are focused on. We are really excited about this debt validation fund. It's just got phenomenal returns. I actually sat back on the sideline for a while and let Matthew do his thing with it, just to see how this thing was panning out. And it seemed to be doing really good. I mean, he kept me in the loop. Like he said, he's done a ton of due diligence on this. He put on his forensic accounting hat and deep dove into this. So we're excited to share it with you. And enough about us. Let's get into the deal.
All right, let's see here. So just to give you guys a quick overview of the deal in itself, what we're doing is we are actually securing our money. Go back one. There we go. All right. So we are investing secured against very large pools of accounts receivable, and we're helping people invalidate their debt through the debt resolution process and the legal process. And so what happens is you have people that are high in credit card debt, that are struggling, that can't make their minimum payments, that then get sold off to collection companies from the large banks and institutions out there that provide those credit cards. And then those collection companies usually are buying that debt at like 2 cents on the dollar and collecting 5 cents on the dollar and killing it as far as their profits go, of course. And they many times don't necessarily have a right to that debt. In addition to that, they don't necessarily abide by the Fair Credit Practices Act or their legalities in their collection practices. And when they don't abide by the law correctly, that opens it up for attorneys to then step in and say, cease and desist, creditor, my client doesn't owe you this money. We're going to sue you for not being able to, or for not abiding by the law here, wipe out this debt, and we'll put you in and typically they're able to invalidate that debt and wipe it off the client's books. And so what's happening here is they're coming in and they're saying, what are my options? Someone that has, major credit card debt. One of their options is a consolidation loan at a much higher, very high interest rate still. You're consolidating all your credit cards in one place to be able to pay them off. And most people can't afford that because, of course, they're not able to afford the current monthly payment. So, being able to afford that consolidated payment isn't going to really help much. The other option is to do a haircut for those people where they can go and take a lower settlement amount for each card, and then they lower the payment. They still have a high interest rate, but that stays on that client's credit for 7 years, just like, bankruptcy or something along those lines. Or they can go bankrupt, right? And any of those situations, and the current method really is detrimental to that client. And so then came along debt invalidation, where these laws were passed to protect the consumer here, and now it enables attorneys to help the consumer be able to invalidate that debt. So they take somebody from $20,000 in debt that has $1,000 minimum payments, for example, with 20% interest, and they put them on a legal and contracts receivable for $6,000 on average, that is fully paid off in 24 months at around $300 a month with zero interest. So they're able to then wipe out those debts, and they're off of their credit report and in a much better position across the board with their financial position. So they're taking them and putting them in a great, I'll say, starting point for financial success. And we're actually right now building financial education programs behind it. A lot of these people get into trouble from medical debt and those types of things. So it's important to understand the concepts here of what we're doing and how we're helping the community here as well. And we've set up discount programs for those first responders so they can get massive discounts on that debt. And I'll kind of explain the process so you guys understand where the risks are and how we kind of dived into these. But right now, there's a 36-month term. We're utilizing investor capital and lending it against these accounts receivable contracts, these giant pools of receivables. So on like $5 million, that's like 3,300 receivables at the typical cost of the investment, so of each contract. And so we're talking about 20% annualized returns to investors. So if you invest $100,000, you're getting $20,000 for the year, and then $5,000 a quarter basically is how it breaks down. And they're secured by those contracts at 25% of what they're worth. So if the average receivable contract is $6,000, then we're secured at $1,500 is our cost on that particular deal, okay? So, and these receivables have an 80% collection ratio, so we're at 30% of the historical collection value of these giant pools of receivables. And the diversity as well as the collection ratios is what gives us that protection of our equity against those deals, and we secure it with the UCC filing against those accounts. So what is debt invalidation? What they're doing is they're helping these clients to invalidate their debt through the legal process. There's about 200 different ways to be able to invalidate that debt dependent on the creditor. So a client comes to them, they analyze all of their different credit card accounts to be able to determine which accounts those collection companies have had actually, abided by the law and didn't abide by the law. There's companies like Discover Card or, you know, other small credit unions that don't necessarily sell their debt off. And so some of those debts cannot be invalidated. And so they're analyzing each one of those cards to verify which ones they can. And their legal services and contract services are dependent on which cards they actually are able to invalidate based on their upfront review of their situation, as well as their financial situation, and looking at what their income is to make sure they can afford those debts, and analyze that position as well, to make sure they can afford the legal fees to pay over that 24-month period of time. So, but what's awesome is at the end of that 24-month, they are, you know, all those credit accounts that they signed up for are wiped out. So they're able to typically be able to wipe out 40 to 50% of their total overall debt. And we've seen some in the 90% range to just wipe those other debts out that they, you know, legally can be invalidated, right? So, and then we've seen a historic collection ratio of 80% on these accounts. So on a $5 million investment, that's 3,300 receivables that creates or receivable contracts in number, and the dollar figure is about $20 million of contracts. That's $16 million collectible on a $5 million investment. So that's why they're able to pay a 20% return, because if they go pay 20% to the investors, they're in it for $6 million now, and they still have they have 16 million worth of collectible receivables that they typically collect on these accounts. And so we're secured against each one of these accounts at around $1,500 on a $6,000 receivable. So 4 times the amount of our investment amount, which is what makes me feel a lot more comfortable. If I'm going and investing against property, I want to look at the loan to value of that property. Normally we see 75% loan to value, what people will loan against the value of that property, right? But out there, but in this case, it's receivables and giant pools of them. It's different collateral. So we lowered the actual loan to value, being at $1,500 on this at 25% of that value. And I'll explain where that $1,500 comes in, and it's why it's $1,500 in a second when we kind of go through the flow chart so you see how this is actually working. Let's see, going the wrong way. Okay, so what's happening here is we have marketing partners that are set up that are going out and finding these clients. They're spending money on labor time, on pay-per-click marketing, to be able to actually find these clients that are in need of these legal services and contract services, and they're finding them for resolution partners. Normally, the cost to them is around $1,000, and their profit is $500. So these marketing partners are going out there and trying to find all these different clients to bring them on board that need these services. And if those clients don't make at least 2 payments on that account, that $1,500 is clawed back, and those marketing partners don't get that $1,500 as a safety mechanism to make sure they're finding real clients, to make sure these clients are paying and on time as well, and are starting off on a good foot, okay? So next, Resolution Partners comes in and they find the client, and they start analyzing their financial position, all of their accounts, and doing a full legal review of those specific accounts, okay? And what's happening is they start making payments to Resolution Processing and to the attorneys of around $300 total. Resolution Partners is doing all of the legal work, doing all of the administrative work associated with this, and the attorneys are doing the legal work for the cease and desist letters, and Resolution Partners is doing all the collections, doing the contracts, reviewing all the accounts, doing all the administrative. They're doing probably 90% of the work, and the attorneys are doing the other 10% of the work associated with this. And so you can imagine, you know, these are small figures for attorneys, but when you're talking about thousands of clients, you know, that it starts to really add up for those attorney fees. So they're really excited to get new clients like this that they can, you know, bill out for in this way. And they're taking these clients from a massive credit card debt down to a simple payment that gets paid off in 24 months with no interest. So huge benefit. And so us as the investors put up the $1,500 on that client. And so on a $5 million investment, that actually creates a cash flow of $833,000 a month of receivables income And the interest payment to the investors in that case is around $83,000 a month. So there's still a very big spread there that then can be invested into more contracts, increasing the collateral further, as well as having that big cash flow spread enables them plenty of bandwidth to be able to pay investors back. This is a 36-month term investment. So the idea is to allow them to buy more contracts. So then that way their cash flow goes up and up and up as well, and it starts to snowball, and they have no problem paying our funds back as well based on those contracts. So little background just on this piece. The minimum fund size is 250,000. We've already hit that. We're way above that now. I think we've raised around 4 million as of right now on this project, and with all the funds, we did debt fund 1, and now this is one is debt fund 2, and I'll kind of explain that in just a moment. And so with all of it combined, we raised a little bit over $12 million for these investments. Class A1 members and A2 members. The A1 members and investors invest over $1 million. They get a 25% preferred return, and A2 members is a 20% preferred return. And then the managers make the return above that in an interest rate spread, and that's how we as the managers make money. There's no management fees, no upfront costs, so there's alignment of our interests with our investors' interests, with us getting paid on the back end after investors get paid. So in the, like I mentioned, 36-month term, quarterly payments, minimum investment is $50,000, and it's secured against those large pools of receivables. So let's talk about that process just one more time to help get that clarity. So the marketing partners find the customers with 20K plus and credit card debt and in default. And then they go out and they charge resolution processing $1,500 per customer after the quality control and the financial review is done on that specific client, and they sign up for those services. And then the customer enters into that service contract, start to be able to make those payments on those receivables. And then the receivables are approximately 40 to 50% of all their debt is then able to be invalidated through that process. And then those monthly payments start with about an 80% collection ratio. The contract services then continue to happen over the 12 to 24 months. In the invalidation process to wipe those debts off typically will take 12 to 24 months, which is why the payment is done over that period of time as well. And then the consumer debt is invalidated and it's removed from their credit reports. It actually helps their credit as well, but they can't market that as well because of some legalities involved in saying that they're a credit repair company when they're helping people invalidate their debt. It's just part of the process. So like I mentioned on that example, on $5 million at $1,500 a cost, that's 3,333 contracts at $250 a month. That's $833,000 a month in total payments. And so that's 5 million equates to 20 million in receivables. So that's historically 16 million collectible. And I've actually gone through the process here with resolution processing and seen this entire thing happen before I ever raised capital from investors for this. And I've been raising capital for a long time. I put in 250,000 of my capital to actually invest first with them, to see that through fruition, to see them acquire those contracts, get the filings against these contracts, and get paid off on my funds. And then we actually raised Debt Validation Fund 1, and we did a $2.5 million tranche, saw that all get implemented and start to perform as well on that before we did before we did the second tranche of that, another $2.5 million for Debt Validation Fund 2 as well, or Debt Validation Fund 1. So that way we did that full Debt Validation Fund 1 before we started 2 up and saw the performance happening with that fund before we started this fund now with Debt Validation Fund 2. So we tried to go through over a period of time, like a 3-year period, vet all of this stuff. I actually went through and looked at samplings, like when I used to work as an auditor at a CPA firm, they would go through and do samplings of contracts to verify things. And we went through about 25 to 50 different contracts, some that paid off, some that, were in process already, some that, defaulted and stopped paying. So we went through those contracts. We went through the bank accounts to verify that payments are getting made on those contracts, that the capital is coming into the account. So this is some of the background stuff we did. We had background checks done on the operators involved. When we're lending money, those are some of the due diligence things that you want to do to make sure that you're protected. And then we get UCC filings against those contracts to secure our interest against those contracts. So if the borrower ever defaulted, we have the ability now to come in and take over those contracts, move them to a new servicing company, and continue to collect on those contracts. And as of December 31st, we had about $12 million of total capital raised on this project. We would expect about 48 million of total contract value, but because of the additional acquisitions, they were actually at $62 million of contract value, so about 19% cost to value instead of about 25%. So I know I just talked really fast there. I'm just trying to give you guys, some of the stuff that I've done on this to be able to protect myself as well as my investors involved, and all the good people that Charlie works with, of course, as well, trying to dial this in as best we can. I'm always open to additional due diligence. If anybody sees other due diligence we can do, I want to dial that in as best as we can. I think we've done a great job on this, of that detailed deep dive. The risk on this is the collection ratios and, the performance of this debt and the operator involved. And so I took our time to review that in depth up front, doing business with the borrower here, resolution processing, to see the systems and see how it was working. And then, of course, seeing the 80% collection ratios occur, of course, as well. So just to give you all that great info. So again, we'd have to have a 75% default rate instead of 80% or instead of 20% default rate in order to break even on our 25% cost to value investment. So this is what gave me a good feeling about this and felt comfortable with the risk. You have to assess that for yourself, of course, but at the end of the day, that's one of the biggest things I considered, especially when you're dealing with a pool of these that's this big, where you're talking about thousands of receivables, and we're raising $50 million. So that's like, 33,000 receivables that we're talking about here. So the payment structure, ends up like this. On a typical $100,000 investment, you're going to go and get, your returns in this way, 5% a quarter for 12 quarters, to make a total of 160% on your funds. They do have the right to pay off early, so it could pay off in 24 months or something like that. It depends on how fast the marketing partners grow, because their only inability to grow right now is capital to be able to buy more contracts, and from those marketing partners. The marketing partners are pushing to be able to do that at the moment. And so we're raising capital so that way they can go and buy more contracts, and we're at 25% of the value of those contracts. So, they're very happy, and we're very happy with our 20% returns, of course, as well. It's a win-win relationship for everybody. And I'd be fine with them paying us off early if they made great money and we made great money along the way. Oops. Here's a example of some of the accounts receivables pool here. So you can see the enrolled dates, the monthly payments, the debt that they enrolled to sign people up for, that they're trying to invalidate for people, the program length, the cost of the program, total, the legal fees, the legal services, the service fees, the payment dates, and the purchase prices of these things. So that way you can see where, we're dealing with averages here across the board. This is just one small pool of receivables that we, pulled for this example. So again, what's awesome about this is we're actually able to help the community. We have QR codes set up for those first responders, those active duty or military vets, the police and firefighters. My dad was a ranger and a sniper in Vietnam, and I have a very big military relationship base with a lot of my friends that are Marines from Camp Pendleton, and we've trained a bunch of Marines to try to teach them financial freedom. And so I really want to find any way of helping that and that piece. Even if you don't invest in this thing at all, please take our QR code and be able to share it with people to help them if they're struggling struggling with credit card debt to be able to help them get out of that, process. It really, I feel like it's one of the biggest problems with society today is the lack of financial education as well. So we're trying to add that financial education piece to it too. And it's a really big passion of mine to be able to help people on the financial side because I see it being, the system set up in a way for failure for people. There's a reason why, I had 20 credit cards when I was 19 years old because I wanted all those free t-shirts in college, So that's the way things are set up. So again, 20% annualized returns paid out on a quarterly basis. The way it works is if you fund as soon as you fund, there's a 10-day window for banking and getting those funds invested that there's a no interest period. And then there's a proration from the 10-day mark to the end of that quarter. So if you invested today, then you'd have the end of March basically you'd get a prorated portion for, or the middle to the end of March, and then after that you have March to June, and that's a full quarter. You get paid out the full quarter and the proration at the end of that first full quarter. So at the end of June. So that first check will be a little bit bigger as well. So we try to prorate into a calendar quarter for payouts on this. So again, we're filing the UCC filings against these every quarter. I'm also doing that deep dive every quarter on this moving forward to make sure that I'm checking these samplings of contracts for all new contracts that are coming in and checking the banking and the profitability of resolution processing as well with part of the process. What's awesome is we can make great money. We can provide a good to society. Resolution processing can make great money as well. So it seems like a win-win for everybody here. So if you're interested, we use Syndication Pro for our software. So you have a nice little portal that you can go into. It takes about 15 minutes to literally go in and sign the documents and handle that side. Typically, you create an account that takes like a minute to do that. You create a profile for the investment entity you want to invest in. That takes another couple of minutes. And then you press the invest button and run through the documents. You obviously have the ability to print out and read all the documents. I highly recommend that. If you need some sleeping material, yes, it puts you to sleep, but it's important that you guys read these documents and be able to understand the provisions. And we're here for questions. We have a full Q&A on every question anybody's ever asked about this investment. We have a custom GPT available for this investment, so you can just ask questions to it and it'll actually answer those. And then of course, us and our team and Charlie and Cam will all be available for you for questions on this investment along the way. I highly encourage you, do your homework, dive deep into this stuff. I did, and I became a lot more comfortable once I started seeing the structure, seeing the cost to values, understanding the businesses that we're investing with resolution processing as well. So we're here for you guys. The process takes like 15 minutes to actually sign up in total for those documents and everything. And let us know what other questions you have along the way. You sign the docs, we approve you, and then you send the wires and you're invested. And within 10 days, you're making 20% interest on your money. So it's kind of an exciting thing. I love doing this stuff and finding ways of beating inflation in this way. One other really cool thing. We actually are designating this as ordinary income instead of interest income. And the great reason we did that was because interest income is considered portfolio income, and you can't take real estate losses or depreciation against portfolio income. Many times people try to buy real estate, front load the depreciation with cost segregation deductions and take giant tax deductions in the first year. It's a strategy we use consistently on the tax side. But many times you're limited by the amount of passive cash flow you have from rental properties. And what's great is when we classify this interest income as ordinary income, because we are in the business of lending money, then it creates passive income for the LP partners, our limited partners, and now you can take those big cost segregation deductions against this interest income or this now ordinary income with the debt validation fund. So really cool concept to think about because now you can utilize tax planning on this and buy real estate. We buy stuff every single year for the tax deductions. I bought a mobile home park a few years ago, invested 600,000 and got a $600,000 year one tax deduction. And it sounds like the 100% bonus depreciation may be coming back shortly as well. So really great time to do some tax mitigation strategies in your investment portfolio. And I highly recommend investing in both real estate as well as debt to counterbalance those things so you get set cash flow as well as the inflation benefits, the leverage benefits, the cash flow and value add you get with real estate type strategies as well. So, but thanks guys, I appreciate it. Charlie, Cam, I don't know if you have anything else to say here, but we can, Charlie can, send you guys the links and everything. There you go. Contact info for Charlie here.
Yeah. Thank you so much, Matt. We appreciate it. And Cam, yeah, guys, you'll get this recording of this webinar in an email probably by tomorrow. We'll send that out. And yeah, if you guys have any questions at all, feel free to reach out. If there's anything that me and Matthew both, we can hop on a call with you and talk about any kind of questions you might have about it. But thanks for joining us today, guys.